Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am your host, Christopher Cahill. Later on, we'll have an interview with Jilliene Helman, Chief Executive Officer of Realty Mogul. And Mogul it is. But first, a few boring notes about brokers and then a more exciting note about robots. The boring notes about brokers do illustrate, I think, a few important truths. I refer to an article from Reuters.com dated September 30th, 2014 by Sarah Lynch entitled SEC's Piwowar Proposes Alternative to Broker Fiduciary Rules. Mr. Piwowar is a Republican member of the SEC, and the issue is that there are confusing rules. Investment advisors are subject to a higher fiduciary duty than brokers. Fiduciary duty meaning they must put a client's interest ahead of their own. Brokers are held to a lower, quote, suitability standard, end quote. Well, the SEC has been discussing internally whether to apply a uniform fiduciary standard. It does strike me that having different standards is great for lawyers. I'm not sure how much this provides practical protection for anyone else. The article also notes that, Piwowar's argument that a uniform standard, a fiduciary standard, might harm investors by limiting their financial advisory options. That is, I guess, that some brokers would not be able to meet the fiduciary level of responsibility. Perhaps that's what he means. But he also said something else which I thought was important. He says that in calling for better disclosures to eliminate investor confusion, he draws on his own personal experience, saying that when his advisor recently switched brokerages, he was handed, quote, a thick packet of paper, end quote, that was filled with worthless disclosures. Well, I guess a thick packet of paper might give you the false sense that a disclosure is being made, but can you really read and understand a thick packet of paper? Is more disclosure better when the greater volume frustrates your ability to understand what's there? And I guess I can't let this go without observing one of the fundamental problems under the Madoff scam. Here you had Madoff operating in plain as day, offering reliable returns that were very high, and he wasn't really questioned even by sophisticated investors who should have known better. And perhaps some of that was due to the presence of the regulator in the first place. Regulations, like big fat disclosures, can give a false sense of confidence, a false sense of security. Somebody's looking at this, you might think. Well, that wasn't the case with Madoff. Now, a little bit more about brokers. This also from Reuters.com, Monday, September 29th, about FINRA. FINRA, the industry group that regulates securities brokerages, has decided that it cannot force firms to carry insurance for payment of awards granted by arbitration panels or courts to customers who have lost money. We're talking about brokerages. Why can't FINRA force brokerages to carry that insurance? Why not? Because underwriters don't want to insure for that, especially at, quote, higher risk firms, end quote, which are the ones FINRA would be most concerned about it. So here's a quote from the article. In 2012, the latest year for which data is available from FINRA, brokerage firms failed to pay $50 million in awards to customers. In 2011, about the same. So if you have a loss from a brokerage firm, you suspect it's something bad, and you can establish that in court, can you collect? Well, the real person to ask, of course, is one of those attorneys I mentioned earlier who benefit from rules that aren't exactly clear and who benefit from the existence of shady brokerages. The article quotes a lawyer named Pfeiffer, who says, I've had exponentially more people come in this past year that I've ended up having to turn away for collectability than he has in the prior 14 years. So It's hard to sue people and it's hard to get money from them unless they have insurance when it comes to brokerages. Caveat emptor is really the way to go, even when there's the presence of regulation. Maybe that's the lesson of all of this. But on to brighter things, the future. And what's the future? The future is going to Lowe's and other places like Lowe's and encountering robots instead of employees or in addition to employees. Lowe's Companies is introducing robotic shopping assistants at an Orchard Supply hardware store located in San Jose, California. Robotic shopping assistants. Of course, the first thing I think of is one of those things running over my feet, but I'll go on. The OSH bot, the OSH-bot, will greet customers, ask if they need help, and guide them through the store to the product. It has natural language processing technology. It's 5 feet tall. It's a white robot that houses 2 large rectangular screens, front and back, for video conferences with a store expert and to display in-store special sorts. It's a moving display sign, a moving display case, and a connection to those who know to help you through what can be a bewilderingly large store, admittedly. The OSH-bot can also help customers match a certain size nail or hinge with a 3D scanner and determine if that part is in stock. Hey, I've got this hinge. Do you have this part? Well, that's actually pretty cool, especially if you're looking for small parts like wing nuts, for example. In the future, OSH-bot may be able to create the part with a 3D printer, said Marco Mascore, CEO of Fellow Robots. It's a very reassuring name. So you go up to the robot and say, you know what, robot, I need an 18/8 stainless steel wing nut. Oh, wait, no, I need one with a thread size of 1/4 to 20. And I need another 20 that have a thread size of 5/16 for 18. And out it comes. Well, you don't have to root around in the trays, but maybe you like rooting around in the trays, I don't know. But it isn't just Lowe's, it's hotels. In August, Starwood Hotels and Resorts worldwide introduced a room service robot at its Aloft Hotel in Cupertino, California. Of course, that's where lots of people from the electronics and high-tech industry might be staying. So they might really dig having a room service robot. I don't know about everybody else, but maybe we would too. I think we're going to see a rush of companies wanting to be the first in their industry to have robots, said a man from the OSH-bot company. I'll go a little further. The International Federation of Robotics estimates sales of more than 400 robots worldwide in the next few years that serve as guides or information providers in places such as supermarkets or museums. Well, think about that. They're in the museum, they're in the supermarket, they have a 3D scanner, they have a 3D maybe printer. I mean, I guess I'd be happy if there were a robot showing me around the zoo that had a 3D printer, or maybe even just a Mold-orama would be good enough for me. This was from the Wall Street Journal, October 28th, an article by Rachel King entitled, Newest Workers for Lowe's, Robots. Well, that's got to be enough from me. Let's get to our guest.
Thanks, Chris. Welcome to Accredited Investor Markets Radio. I'm Alicia Purdy, Managing Editor of AccreditedInvestorMarkets.com, and today I'm speaking with Jilliene Helman, CEO and founder of Realty Mogul. Jilliene is responsible for strategic direction and operations, and she sits on Realty Mogul's Board of Directors and Investment Committee. Jilliene has underwritten over $5 billion of real estate and was previously a vice president at Union Bank, where she spent time in wealth management, finance, and risk management. Jilliene is a certified wealth strategist, holds Series 7 and Series 63 licenses, and has a degree in business from Georgetown University. Thanks for joining us today, Jilliene.
Thanks for having me.
Today we're discussing real estate crowdfunding. So to begin, would you please introduce Realty Mogul to our audience and tell us a little bit about what you do? We've heard that you are the largest crowdfunding company in the U.S. for accredited investors. Can you share on that a little bit?
Absolutely. So Realty Mogul is a marketplace for accredited investors to pool money online and buy shares of pre-vetted real estate transactions like apartment buildings, shopping centers, self-storage facilities, office buildings. We do this concept of real estate crowdfunding, and from a 1,000-foot view, crowdfunding just means pooling capital together on the internet. So we make real estate investment opportunities available to a broad network of accredited investors through our website at realtymogul.com. and we provide a variety of different real estate transactions for them to invest in. We've invested in almost every asset class, from industrial real estate to retail. We've done something in mobile home parks. We've also been very active in apartment buildings and self-storage. So, our aim is really to give investors a broader access point to real estate transactions across the country.
Okay, so the word crowdfunding. Most investors have heard about the general term quote-unquote crowdfunding because of sites like Kickstarter, which is the rewards-based investment style. And credit investors and their advisors are kind of waiting, to hear more about the equity crowdfunding. What category does real estate crowdfunding fall into? Is it one or the other? Is it a little bit of both? How does that work?
So we do not fall into rewards-based crowdfunding like the Kickstarters of the world. We fall into sort of two other categories, which are equity crowdfunding and debt crowdfunding. And the overarching theme across equity crowdfunding and debt crowdfunding is that there's the potential for a real financial return to the investor. That return is never guaranteed. There's real risk in these investments, but there's the potential for a financial return. And in equity crowdfunding, investors are buying equity. So when you apply that to real estate crowdfunding, you're buying equity in a building. In debt crowdfunding, you're buying debt. So your investment may be secured by a loan against a property, for example. And Realty Mogul does both. So we provide both equity opportunities for investors and debt opportunities or loans for investors.
Has one proven to be more popular than another so far on Realty Mogul's site?
It's interesting. Different investors want different things. Accredited investors are a savvy bunch, so I wouldn't say that one has proven to be more popular, but there are certain investors who favor debt over equity and other investors who favor equity over debt. We do see, investors go through both channels, but it just depends on the investor and what their, individual asset allocation looks like and what their individual investment preferences look like. Because at the end of the day, investing is a very personal thing.
Okay, so it's really just a matter of personal preference versus what's trending.
Right.
Okay. So I was exploring the Realty Mogul website a couple weeks ago, and I saw an article there called 5 Reasons for Passive Real Estate Investing. Is that what this means? And what is passive versus active real estate investing in this case? And can you expound on that 5 reasons for our listeners?
Sure, absolutely. So, one of the things that's important to us is education. So we wrote this post around 5 reasons for passive real estate investing. The first one is let Uncle Sam work for you. So what we mean by that is passive real estate investing allows for some tax-deferred returns in some investment opportunities. It's not in every opportunity, but in some opportunities you can write off depreciation. So the investor can write off depreciation from their taxes, and for investors like accredited investors who tend to be in a higher income tax bracket, they get this offset of depreciation. The next one around passive real estate investing is no tenants, no toilets, and no trash. So number 4 is no tenants, no toilets, no trash. And what this means is that you don't have to deal with the day-to-day hassles of property management. As a passive investor, you're not going to deal with a leaky faucet or a broken toilet or a pipe that's burst. The property manager is going to deal with that, or the real estate company who are investing alongside is going to deal with that. Number 3 is there's no bank to deal with. So when you're an active real estate investor and you want leverage, you typically have to work with the banks. And getting a loan from the banks these days, there's a lot of documentation, there's a lot of hoops and hurdles that you have to jump through. As a passive investor, the real estate company that you're investing with is going to do that work. So you don't have to deal with the bank. Number 2 is leverage the smarts of other people. So interestingly enough, we have accredited investors who are investing with us today that are actually active real estate investors, and I'll share a specific example. We have a real estate guy who does a lot of apartment investing, and he's an active investor. He acquires them. He does the property management. He runs the transactions, but he has no expertise in self-storage. And he started now investing passively with us with some different real estate companies in self-storage to leverage the smarts of other people, which is the number 2 reason. And what he's doing is he's relying on all of this pent-up knowledge from these other real estate companies that have this specific focus in self-storage so that he can profit from that, or ideally profit from that. So one of the things around passive investing is really leveraging the smarts of other people. And then the number 1 reason for passive real estate investing is the potential to make money while you sleep. The interesting thing about the difference between active and passive investing is when you're doing active investing, it feels like a second job, right? Maybe you have a day job, and then in your second job, you're doing property management, or you're dealing with tenants, or you're showing the property. Passive investing, you're literally making money while you sleep, and the while you sleep piece feeds into real estate because you have tenants who are paying you to be in that asset, right? Either you've got an apartment building where people are actually sleeping in that asset and they're paying you and paying the passive investors rent to stay in that apartment. You've even got office where, I rent a pretty sizable office building for our company and we're paying for that office day or night, whether we're in the office or not in the office. So that sort of potential to make money while you sleep, while you're not actually doing anything active is the number one reason that we identified for passive real estate investing.
Okay. So for the people who are concerned about becoming a slumlord or something, or they don't want to go deal with, the headache of a plumbing nightmare or something, it sounds like it's a really ideal way to have a part of real estate, since it is extremely trending right now to have real estate, but you don't have to have your hands dirty, which is great. But then you would also have to have land managers and property managers that you trust that are equally invested. Does Realty Mogul have anything to do with that? Or how does that work? If you want to invest, who's there? Who do you trust to actually take care of your investment?
So we're working with a network of real estate investment companies. Sometimes they're called sponsors if we're doing equity investments, or they're called borrowers if we're giving them a loan. And these real estate companies are the ones who are being the active investors. So they're actually on the ground acquiring real estate. They're on the ground working with the property management company or managing the property managers. They're responsible for sort of the day-to-day on the transaction.
Okay. We know from just general investment advice that there are tremendous benefits to diversifying an investment portfolio. What kind of diversification does real estate crowdfunding provide? You mentioned such an array of types, and I'm sure that's in one aspect of it. Does it do other things for diversifying your portfolio?
Yeah, absolutely. I think that, one of the biggest pieces that may be the most obvious piece to diversification is just being able to see a lot of transactions that you can even invest in. And, from my perspective, I think that crowdfunding gives investors unprecedented access to deal flow that they wouldn't otherwise see. Our own company, we've seen $5 billion in deal flow, and your average accredited investor just isn't seeing that kind of deal flow. So I think that, there's a huge benefit of diversifying across real estate, and crowdfunding provides you access to even have that opportunity to diversify, and that opportunity to say, I'm going to invest across 30 transactions as opposed to investing a higher dollar amount in one transaction.
Okay. That's actually a great segue into my next question, which is your website had noted that Realty Mogul provides access to equity and debt that would likely take several months to secure through more traditional means, and by traditional you had noted slow and restrictive. Can you give some examples or explain for our audience what the benefits are of that for investors, and then conversely what it is for capital raisers that makes it sort of a win-win on both sides?
Yeah, so online capital markets and this concept of crowdfunding and what we're doing at realtymogul.com is speeding up a process that used to be very, very slow. You used to have to go out to individual investors, and it was sort of this country club network of investors who might get access to these transactions. And if you can provide capital faster to real estate companies, then you tend to see better deal flow. At the end of the day, it's all about getting access to the best deal flow, and there's good deal flow and there's bad deal flow. Don't get me wrong, and we see both of it. And we've come up with ways to kind of weed out bad deal flow. But by being really fast and by using the internet and online capital markets to speed up the ability for us to give capital to real estate companies, I think it means better deal flow for investors. I think it means real estate companies who are really satisfied with our service, which again means they're showing us more deal flow, which leads back into better deal flow for investors. And also this concept around certainty of close. One of the big concerns for real estate investment companies is the cash going to be there when I need to close? When I'm ready to purchase this property and finalize the acquisition, is the capital really going to be there? And one of the beauties of online capital markets is that the capital is there. It's sitting in an escrow account, ready to be deployed into that transaction because our entire process is online. Our entire transactional process is online, so that allows it to be really scalable and really fast.
And probably more transparent as well, I would think.
Right, ideally.
Yeah, I know that investors like to feel that sense of control that they can go in and peek around and see what's going on. Are they able to do that as well?
They are, yeah. They're able to go online and see sort of transparently in every transaction that we've got up.
So what's the difference if someone old school style investing, and I use old school tongue in cheek just because it's still very real and relevant, but what's the difference between real estate crowdfunding that Realty Mogul is doing and investing in real estate through something like an REIT, a real estate investment trust. Will you contrast the benefits and the drawbacks of that? Because investing online with real estate seems like such a stellar idea. What would be the contrast in someone kind of going through the older method of the more established method, I suppose, of real estate investment trusts?
Right. So, real estate investment trusts or REITs have been around for a long time. And one of the great benefits of them, at least the publicly traded ones, is that you can buy and sell them like a stock. So publicly traded REITs, you can buy and sell online like a stock, just like you're buying Apple or a bond. You can trade, you can get in and out. There's highly liquid markets for publicly traded REITs. That's in contrast to real estate crowdfunding, where it is highly illiquid. So I'd say one of the drawbacks of real estate crowdfunding is this concept of illiquidity and the fact that you can't trade these assets very easily because there's no public market for them. That being said, the flip side of that is that if you're in a real estate investment trust and the equity markets crash, you're going to have equity exposure. So you're going to have exposure to that equity market crash, and the value of that REIT may drop substantially, even though the underlying value of real estate hasn't necessarily changed. So you've got equity market risk. The other thing that I think is interesting about crowdfunding in comparison to REITs is this idea around control and transparency. When you're investing in a REIT, you're typically investing in a pool of assets. It might be, 1,000 apartment buildings, or you might be in an office REIT where you've got 500 office buildings. With crowdfunding, you've got more control about the specific asset that you're investing in. So as an example, we recently bought the Hard Rock Hotel in Palm Springs, or invested in it. Our investors knew the exact hotel that they were investing in. We bought a self-storage facility in Arizona. Our investors knew the exact property that they were investing in. So that's kind of some of the similarities and differences between crowdfunding and a real estate investment trust.
Do you find that people like to invest in what they can, if not necessarily physically touch, but at least know what it is, know where it is, could get to it if they wanted to? Is that something that investors really like being able to do, which a REIT does not necessarily provide?
Yes and no. So there are some investors who really like to invest where they're located, right? So there were a handful of investors who said, I'm really interested in investing in the Hard Rock Hotel. I'm going to go drive the property. And they did, and we set them up with site visits and tours and all that kind of stuff. There are other investors who I think use crowdfunding to get exposure to geographies where they don't have a physical presence. So somebody in New York who's investing in, California or Texas because they don't otherwise have a network in those markets for them to get exposure to those real estate markets. So it really depends on the investor, and it goes back to this concept that I believe in very deeply, that is, investing is a very, very personal thing.
So in your experience so far, it is a personal thing. Do you find that a local focus, and I mean a micro-local, like maybe in someone's town or in their, I don't even want to say state, maybe their county, it is more popular than to invest broadly, or is it really still just really depending on the investor?
I think it goes back to depending on the investor.
What are the benefits of investing locally versus something on the broader scale? Broad geographic reach was something that I had read about on your website, and I was really interested in that. I'm someone who would probably lean toward investing locally. I like to, buy my corn locally, so I'm really into the local economy, and if there were an opportunity, I'd be the person, if it were my personal choice, to go put my money locally. But what's the benefit of expanding outside my town, my city, my county, my state?
I think that, investing locally, a lot of investors have that comfort level like you do, which is important. And investing on a broad geographic reach just adds to the diversification. I'm a big believer in diversification, and as you're allocating assets, even across different asset classes, whether it's stocks, bonds, real estate, gold, other places, small businesses, startups, I'm a big believer in diversification, and one way that you can get diversification is through geographic diversification.
So just in theory, if I were to be an investor in Realty Mogul and I wanted to go on and look around, are there opportunities to invest really locally, as many as there are on a broader scale? I mean, I live in Ogden, Utah, for example. How does that work if someone wanted to go in and just be really specific and type in their city?
So we've only got, so many investment opportunities at any one given time. I'd say in a market like, Ogden, we haven't done a transaction there, so you wouldn't have a whole lot of options locally. But as we grow as a business, we're doing more and more in new markets. But it would just depend on where you're based, right? For those individuals who are based in, Los Angeles, we've done transactions in Los Angeles, and Houston, Texas, we've done transactions in Houston, Texas. We've made investments in 18 states to date. And for those people who want to invest locally, one of the benefits of this being an online platform is they can tell us, hey, I only want to invest in Ogden. Let me know if you have a transaction there. Otherwise, don't bother me, right? So you can kind of set your settings to tell us how you want to interact with our website.
Okay, well, that's really interesting. I did not know that. So someone really could ideally get something in. If you had a deal that came up, they would be the first to know that there was something available that they might want to go check out.
Exactly.
That's excellent. Okay. So let's talk about the deals on Realty Mogul. How are deals vetted? What measure of due diligence is involved? Obviously, we know, and investors should know, that they are responsible for their own ultimate due diligence. Is there a measure provided on Realty Mogul before they start browsing, not precluding the fact that they need to be responsible for their own? But how does that work?
Yeah, so we do a level of due diligence before investments go on the platform, and we do people due diligence where we do background checks, criminal checks, and credit checks. We also do real estate due diligence where we're looking at the asset and looking at the property, the population, the job growth, major employers in the location. But at the end of the day, it's really up to investors to make their own decision. One of the things that we believe in is transparency. So giving investors access to the data and then allowing investors to make sort of their own decisions based on that data and based on how they're underwriting that real estate.
Sure. We kind of touched on this already. Would you tell our audience if they only have exposure to investing in real estate versus a traditional method? And maybe that's even just driving by and seeing a sign, or maybe that's, trying to find something. What is the difference between if someone wanted to get involved in a traditional real estate transaction to invest versus jumping in on some current and really relevant and immediate deal flow on Realty Mogul?
Well, I think that's a broader question about, does the investor want to be an active investor versus a passive investor? If they're driving around looking for for sale signs, my inclination would be that they're looking to be a more active investor and do a lot of that work themselves versus be a passive investor and come to realtymogul.com and make some calculated bets on a couple of different properties. But, at the end of the day, you've got an entire economy that's sort of moving to ease of use, and an entire economy that is moving to collaborative consumption and crowdsourcing and crowd vetting. You look at, not to get too far off on a tangent, but you look at companies like Uber, who has completely revolutionized the car sharing industry and how we think about, taxis and black cars. And Realty Mogul is very similar to that in some respects, which is now you can come to a place where you have transactions that have been provided for you to go in and underwrite. You've got an entire network. We've got 12,000 investors, so 12,000 accredited investors that are asking questions about these transactions, that are doing their own due diligence on these transactions. So it's much more of a community feel than if you're driving up and down the street to identify your own transaction that you're going to acquire.
Okay, so someone who would want to go on the quote-unquote traditional route would have also the responsibility to be that person on the ground, which is what Realty Mogul really helps ease that burden and allows them to be more passive and let someone else do all the heavy lifting. Is that kind of the contrast there? Okay.
Right, exactly.
So let's talk about realtymogul.com for just a sec. You guys have a great and extensive education center, and including a video academy. And I was able to watch some of the videos, and I thought that how broad it was really interesting, and especially for investors who are exploring real estate investing and sort of that more passive route. If you had to pick the top 3 things that investors should know or learn before moving ahead with real estate crowdfunding, what would be on your wish list? What are you seeing that investors, are there any gaps? What do they really need to know?
I think the first one is, what kind of investor do you want to be? So do you want to be an active investor, or do you want to be a passive investor? And we've talked a lot about that on this podcast, so I'll sort of leave it at that, but determine what kind of investor that you want to be. I think the second thing is determine how long you want to be invested. Investing in real estate through crowdfunding is an illiquid proposition. So if you want to be invested for a year, you shouldn't go into a transaction that has a 3 to 10 year, or 3 or 5 or 10 year hold period. If you want to invest for 10 years, you shouldn't go into a transaction that has a 1 year hold period. So kind of figure out what kind of time frame you want around your investments. And then the third thing is really figure out how much risk you're willing to take. And what I mean by that is certain transactions are much riskier than other transactions. Every transaction has risk, and we're a big believer in being open and transparent and honest with our investors that nothing is ever guaranteed. There's real risk in all of our transactions. But I think that the important piece there is figure out how much risk you want to take and figure out, if your investment went down 20%, are you still comfortable in it? If it went up 20%, are you comfortable with it? Like, where is your threshold for where you're comfortable on the risk and reward spectrum?
Are there types of real estate investing that tend to be riskier? And I had read some articles on Realty Mogul and that great education center about different types. And without picking on one per se, some of the examples I had looked at were student housing, mobile home parks, commercial, multifamily. Are there types that tend to be riskier than others, or do they all kind of generally carry the same amount of risk as far as it could do well, it could fail just like anything else? Or is there one that's kind of like, well, higher risk, higher reward?
Yeah, I mean, every transaction has risk, but I'd say that the riskiest transactions tend to be ground-up construction. We actually don't even offer ground-up construction on Realty Mogul to date because we don't believe in the risk-reward trade-off for where we're at in the market right now. But I'd say the riskiest transaction would be construction.
Okay. And we touched on this just a little bit. We touched on liquidity, that the passive investing through Realty Mogul is less liquid and the investment horizons tend to be longer. How do the expectations for returns work on real estate and crowdfunding overall? And what are the risks like in general for this type of investing that an accredited investor should at least know to explore when they're doing their own due diligence? So
I think that there's all kinds of risks that they should be aware of. One is the illiquidity risk. 2 is the market risk. 3 is the property-specific risk. But I think that even more than like learning about the risk, it's knowing the right questions to ask. So, for example, we recently funded a transaction that's in a hurricane location, and we shared very openly and honestly that there was a hurricane risk. But if an investor who wasn't investing in a platform like ours didn't know to ask the question about an environmental risk, they may not have found out about that. So I think that asking about environmental risk, population risk, market risk are kind of good places to start when thinking about risks. But also just ask a lot of questions. I mean, you can always poke holes in investment opportunities, and we welcome inquisitive investors who really want to get into the nitty-gritty of these transactions. Okay, so if they wanted to know if there were a hurricane, if it were in a tornado alley, for example, Realty Mogul is open and upfront about saying that, but they do need to know to ask that sort of thing. They need to figure out what questions to ask. Is that kind of the gist? Well, on our website, we share that openly, even if they if they don't ask that question, because we believe in sort of being very transparent about the risky nature of real estate and private investing. But I think that it's just investors understanding that there's risk in every transaction and figuring out what risks are they comfortable taking, what risks are they comfortable taking versus not taking. So you had mentioned an environmental risk, which sounds self-explanatory. What is a population risk? Is that something like investing in a high crime area, like if you were going to invest in Detroit, for example? Does it have to do with that, or does it have to do with people abandoning an area, or what is a population risk? Well, it could be a location that doesn't have a huge population. So it could be a location with, 15,000 people within a 2-mile radius or a 5-mile radius where, say, you have an office building like that. There's probably not a whole lot of tenants. There's probably some risk that you have a vacancy in the office and you can't get a new tenant because there's not enough people living around there. There's not enough businesses around there. That's sort of what I mean by population risk. Okay, thank you for clarifying that. My mind kind of wandered to a bunch of different areas, and I wondered if our listeners might have had the same question. Let's switch gears for a second. Let me ask you about the Jobs Act and general solicitation. Does that have an impact on real estate crowdfund investing? How does that impact, or does it not? So it does. Title II of the Jobs Act was around general solicitation, which is sort of a fancy way to say marketing. And we have used general solicitation in our own company when we did the Hard Rock transaction. So we were very public about doing this transaction. It was the first time since the Jobs Act had passed that we were able to publicly market it, and we were on television. I mean, I was on Fox News. We talked about the transaction on Squawk Box. We were very sort of open about it. And what it means is that we can get more investors access to these transactions because we can market to them and because we can find those investors. So it's been a pretty fundamental shift in the laws around how you're able to reach and connect with your investor. We had done a piece on Accredited Investor Markets about people using general solicitation to increase awareness about an offering. Have you found that has helped? Has it helped your number of investors to grow, or has it had no impact at all? How has the Jobs Act and sort of that lifting of the ban, has it been great, or has it been blah? Yeah, I think that it's, our experience with Hard Rock was that it was great. I mean, we drove over 100 million press impressions through our marketing efforts. So we definitely got access to a lot of investors who maybe would have never known who Realty Mogul is, right? And it's more than them learning about us, but these investors have to want to do business with us as well. So when we think about marketing, we think about it as, let us give the investor the opportunity to learn more about us. But it's been a good experience.
Okay. We've questioned that along the way to kind of keep an eye out for, would it really explode in popularity, or the lifting of the ban? Would general solicitation really explode, or would it sort of, whimper along? So I'm glad to hear that it's been beneficial. So how do you think overall the real estate crowdfunding industry will be impacted with an opening of these kind of opportunities?
I think that more and more capital will continue to be raised through crowdfunding and through online capital markets.
Let me ask you this just to wrap things up then. What types of real estate investing does Realty Mogul see trending right now? And you can be as broad as you want to be, or go down any rabbit trail, that's fine. But just in general, I know there's probably so many veins that really you could go with that. So if you were to pick something that's trending amongst your own website right now, what vein would that be in?
We're very bullish on cash flow. So what I mean by that is we are cash flow investors. We want to be investing in cash flow real estate. It's why we don't do ground-up development. But I would say just kind of cash flow broadly is what we're really, really excited about from a macro perspective.
Okay. Well, Jilliene, thank you for taking the time to speak with Accredited Investor Markets Radio today. I thought it was really informative. Real estate crowdfunding is something that's really interesting to me, so I know our listeners will follow along with that as well. Our listeners can find more information about Jilliene and real estate crowdfunding at www.realtymogul.com. Thank you, Jilliene, for your time.
Thank you. It was a pleasure.
You've been listening to Accredited Investor Markets Radio, a weekly podcast devoted to educating investors about the basics of investing in alternative assets. We hope you tune in next week. I'm your host, Alicia Purdy, and we'll talk soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.aimkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.aimkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.